Hi, everyone, and welcome back to another episode of the Midtown View. I'm your host, Jim Wenk, and with me today, a very special guest, as always, Matthew Schreck, head of Tri-State Research for Savills here. And we just concluded our third quarter. Is that right? Third quarter, I have that right?
Yep. Absolutely.
In New York City, and we have a lot to cover as far as the state of the market and what's transpired over the last 3 months. Welcome back to the show.
Thanks very much, Jim.
Awesome.
Glad to be back for a third time. It's always a good time.
Awesome. Our market continues to perform at somewhat of an astounding level as far as leasing volume, and I think some of the themes we'll talk about today are consistent and the same as second quarter, and then there's always a couple wrinkles that are happening. But I think big overarching theme is Manhattan is back. Manhattan is back in a big way.
Is it ever?
Yeah.
It is astounding. It's a good word for it. I feel like every single time I say there's a lot to talk about, but there's a lot to talk about, so maybe a long episode. I don't know.
No. Well, we know our attention spans of our viewership, so but we'll try to get the themes and punchlines up front, and then we can expand upon it as we go through it. But I just saw there was a Wall Street Journal article, I think just released today or yesterday, about how robust the Manhattan office leasing market is. And if you would love to just go over some high-level comparative figures, maybe third quarter versus second, or third quarter 2025 versus third quarter 2024, because that will kind of set the table on kind of what's been happening.
Yeah, we can set the stage with some of the latest Q3 data that we just published and reported on. I did see the Wall Street Journal article. It was a good article that captured well how strong this market is performing. And it's sort of astounding. It's unlike any other metro office market, I think, that we're seeing in the US. New York really stands alone right now in terms of its recovery. And in the third quarter, we saw 10.6 million square feet of leasing activity. That includes renewals, new leases, everything. That was the strongest third quarter of a year, I believe, since 2014, more than a decade. And, Q3s from a leasing velocity standpoint oftentimes are slow. It's the summer months, right? July, August, September, decision makers are sometimes away. Not everyone's available to sign on the dotted line. And oftentimes we see, a little bit of a lull in Q3 into a stronger Q4 to close out the year. Oftentimes, this was not one of those times. This was a really, really active, busy summer for the Manhattan office market. So strong leasing volume. The overall market availability rate dropped 100 basis points from last quarter, so from 17.2% down to 16.2%. The Midtown availability rate is now below 14%, and as you sort of slice it down further and further, if you look at Midtown Class A, it's even lower than that. If you look at the availability rate within certain pockets of the city, like along Park Avenue here, over in Hudson Yards, among sort of the best bucket of Midtown buildings, even on sort of a direct basis at the World Trade Center, a lot of these most in-demand areas are seeing availability rates sub 10%, which is really sort of long-run equilibrium type levels. So we're just seeing, continued strengthening of the leasing market recovery. Another notable stat we picked up on this quarter was asking rents, which have been stagnant for so long since COVID. Midtown Class A asking rents grew 3.1% on the quarter.
Wow.
So extend that out, and we're talking double-digit annualized growth. And that's something we expect to continue because it feels like we've reached sort of the inflection point and surpassed it, really, where now there's a lot of competition for high-end space. Building owners are emboldened to start increasing rents. We're seeing it across the board. So that's something we really noticed pop this quarter, and will probably continue to move in that direction. As far as other big takeaways, I mean, the amount of sublet space on the market just evaporating.
Wow.
12.4 million square feet is available, which sounds like a lot in a vacuum, but that's down more than 37% year over year and is actually below the level it was at. This is Manhattan-wide, by the way. That's below the level it was at in Q1 2020 as COVID was taking hold. So
of all the available space,
yes.
37% of it is sublet.
No, I'm sorry. I meant the amount of sublet space, the amount of available sublet space has declined by more than 37% from a year ago. So just a couple years ago, we were over 21 million square feet of available sublet space. So that helps, I think, put into context that the 12.4 million square feet currently available is a far cry from that peak. So
great point.
Yeah, just really strong market.
So if we kind of look at the why,
yes,
right? So like, why is this happening? And you know, I think there's kind of these overarching themes of, you know, New York is a center of gravity for talent. New York has been a leader in return to office for that talent. Some of the primary industries in New York being finance, real estate,
law firms,
legal,
yeah.
And then followed quickly by big tech.
Yes.
Have all been leaders in return to office mandates. So call it hybrid plus or just full-time in office. And then you kind of have some of these macroeconomic factors like interest rates are slowly coming down. You have, I guess, office using employment has been trickling up, you know, steady or trickling up. You have, and then I think the very, very limited supply of, you know, Class A or trophy space in the most desirable areas in New York. So, and then I think that will segue into there is somewhat of a diminishing office stock.
Yeah.
So we had a run of new development over the last 10 years with Hudson Yards and Manhattan West and obviously the Trade Center years ago and some pockets of other new buildings that have all performed exceptionally well. We have some new buildings that are going to be going up in the next, you know, 2 years, 3 years, Madison Avenue, Fifth Avenue, Park Avenue. But it's not like we have 3 or 4 or 5 new buildings today that are delivered.
No.
Because if they were, they'd probably be mostly leased.
They probably would, I think, at this point.
So I think those confluence of factors, but then also that's what's been in the works over the last couple of years is taking some of these older buildings offline for conversions.
Yeah.
So why don't you just touch upon that, you know, where we're seeing that around New York, and do we still see that trend continuing? Because yes, we have a need for housing clearly, but also from a developer standpoint, the office demand is there now, right? So where it wasn't 3-4 years ago. So I'd love to hear your view on that.
Yeah, I think there are just so many different factors influencing the state of the market and where we are today. I think you hit on all those points perfectly, and I totally agree as far as what the demand drivers are, being the concentration of major industries that have been growing, the increased return to office activity nationwide in general, but specifically in New York. I mean, whether you look at the data from Placer, like the mobility tracking, the transit usage, the ridership levels on the commuter rails, the Metro North and the LIRR are almost fully back to pre-COVID levels, and probably will get there soon. So people are coming back in, the buildings are full. That combined with the sort of the previous mentality over the last 5 years, really, of a lot of uncertainty among users of office space And I mean, you know this as well as anybody, but a lot of the activity was expiration driven. It was short-term stopgap deals while we wait and see to what happened, wait and see what happens next. And now we've reached a point where it's become clear that a large component of work is going to continue to be in the office. People are coming back. Firms are more confident in the types of space commitments that they want to make, but everybody is now active in the market at once, it seems. And there's not enough of this sort of high-end, high-quality, well-located, highly amenitized space that everyone wants to go around. So it's making things challenging from a supply standpoint. The only thing I will say before I jump into the sort of supply-demand dynamics is the labor market is the one, I would say, a headwind right now, which is interesting because you have these tailwinds from RTO and sort of the expiration of these short-term deals that many companies had signed, but office using employment in New York City is actually down very slightly year over year. It really hasn't grown at all in the past year. So you've got all these other tailwinds. The interest rate environment, if we get further rate cuts, that could be a tailwind. But the office using employment is really more of a headwind right now than anything else, which is interesting just because you could imagine a near future where if we see more hiring and the economy continues to grow, add another tailwind to the pile, right?
Yes.
And would contribute to an even stronger demand climate. But if there's any one thing to be cautious about, it is that labor market backdrop based on the data that we're seeing. So definitely an interesting thing to keep an eye on going forward.
I kind of have a question. Would love to get your opinion on this. So obviously we're in this, maybe in the second inning of the AI revolution, right? So we hear in the news every day all of the investment and capital chasing infrastructure and AI, data centers, and so which is not quite as relevant for Manhattan office, but you would hear, in the news or certain some business leaders say, well, AI is going to replace some or many jobs,
right?
And I think what's kind of interesting that we've seen over the last, say, 18 months, as the startup capital has started flowing again with venture capital, private equity backing these AI companies, they've done nothing but lease space, lease office space,
100%.
Especially New York being a kind of a bullseye. So, while undoubtedly some roles will be replaced or recategorized, through efficiencies through AI, we're also seeing, it seems like, job creation or new roles with these companies that that are AI led.
Yeah.
So, curious, kind of, do you see that trend, keep kind of, kind of going forward? And
I think it's a net positive long term. I mean, that's just my opinion, but they've certainly been active, these leaders in the AI space, in terms of the office leasing market in New York, and they're going to continue to be active based on what we're seeing as far as tenant in the market activity. But I read an interesting research piece from Goldman Sachs Research a little while ago, and I might be fudging or forgetting the specific numbers a little bit, but I think it said, something like 60% of today's jobs didn't exist, 50, 60 years ago.
Right.
It was some sort of big number like that, because anytime you have major technological innovation along the lines of this AI revolution, it's so disruptive in theory, right, that you definitely lose some jobs along the way during the period of sort of structural change, but then you end up creating all these new needs and roles in the future that it's hard to even envision when you're sort of sitting where we are today. So, that's been the nature of technological growth and advancement in the past. I would think that would continue going forward. You just go through these periods, and I don't mean to be dismissive about it or any way, because it's jobs we're talking about. But you go through these periods of sort of structural friction until you get there.
Right.
But that industry is growing like crazy. Obviously, San Francisco and the Bay Area are the hotbed, but New York seems like it's sort of the next destination, especially when it comes to business applications of AI, right?
Yes.
What better place to be than New York? So, we did some digging into the data and found leasing activity among AI companies, meaning, companies who are really focused on core AI development and applications. So not counting, the likes of Google and Amazon, who have incorporated into their business, but are, diverse, very large, mature companies. So not counting those types of entities, the real AI grinders, if you will.
Yes, young businesses.
Yes, young businesses. They've leased an increasing amount of office space in New York each year since 2023, when we've started looking at this. So went up in 2024. Thus far, through the first 3 quarters of this year, we've already surpassed 2024 levels. I think we're in the neighborhood of 500,000 square feet leased by such firms so far this year. Might be a little bit more than that. And then as far as active requirements, AI firms who we know are out in the market today looking for more space, that totals another roughly 500,000 square feet of space. So there's, all indications suggest this is going to continue. Amazing.
I just want to go back to one point you made about third quarter leasing activity, that typically it'll lag fourth quarter, even first, second quarter. And what I chalk it up to, and this is definitely without having hard data behind it, but I think just by a couple of clients we've worked with, but I think it has to be general view, is companies signed leases because they had to. Mm-hmm. And they couldn't afford to defer it any longer. So whether it's securing that new space because they're having exponential growth, or they were bidding on a space and the landlord had another 1 or 2 interested parties in it, and the landlord forced their hand, in some of these real very competitive buildings or spaces. So the tenants were forced to sign these leases, and for whether it's a renewal or a relocation, it could have been landlord pressure driven, meaning they had multiple offers on the space and they were someone had to step up and lease it, or from the tenant's perspective, they needed to act because they were growing, or they were, the renewal they were doing, the rate wasn't going to last forever. The landlord's ready to increase the rates. So I think, because I know some of that happened with some of the projects we worked on as well.
Yeah. It seems like this is also a little anecdotal, but just from some of the projects that we've been assisting on from a research standpoint, seem today to be a lot more proactive with clients who don't necessarily have an expiration for, sometimes 4 or 5 plus years. But the market is becoming competitive to the point where you have to be much more proactive than you did even a year ago. So we're seeing that, and the supply climate that you touched on is a big part of that. Just the amount of conversions and space being taken offline, the new construction pipeline. Like you said, we're a few years away from anything substantial really hitting the market. So in that time, if the demand climate holds, whether it sort of continues to accelerate or not, if we see more demand for the next, call it 2 years, with little to no relief in terms of new construction, then what does that ultimately lead to?
Right.
More tightness, more competition for the most in-demand spaces, the most in-demand corridors. But I also think one thing we probably need to start talking and thinking about more is sort of demand flowing over to, ancillary corridors and geographic parts of the market that maybe we considered before to be sort of left behind and are now going to be back on the table.
Yeah, I think that's a great point, because I know when we're with clients in Lower Manhattan, we would tell them Broadway was a pretty clear dividing line, whereas you have the offices to the east, the Trade Center in Brookfield Place performing extremely well, and then kind of the properties that have not been converted, but the to the south and to the west, to the east, if you will, they haven't performed as well. You have much more Class B inventory, Water Street, the old Wall Street financial district. You have 60 Wall Street, right, which was being completely repositioned and waiting for an anchor tenant. But I think the time has come where there isn't enough available Class A inventory in the core areas where now tenants will walk a few blocks away from transit, away from their first preferred location, and start leasing in these tertiary locales. I was touching on downtown, but in Midtown, whether that's Columbus Circle, Times Square, going down to the terminal stores redevelopment on 11th and 26th, which is absolutely stunning and stellar, and is going to be magnificent for whomever signs a lease and relocates there. But it's not companies' first choice, despite how great the product is, just because of its proximity to transit. Yeah. But I think that's about to change.
Yeah, I mean, in years past, in the past few years, I suppose, if you were a tenant willing to spend top dollar in this market, you really had your pick of almost anything. So you could target a building that checked every single box, right? Great amenities, new construction, great location, great views. I mean, you could just keep going down the list. You could, I suppose, have it all. And it seems like we're entering a market where you can't maybe have it all, and you have to choose as a user what are the things that are most important to you.
Yes.
And the buildings along the west side in Chelsea, like Terminal Warehouse, and even something like the Starrett Lehigh building, I know I've spoken before about how that area has lagged behind from an occupancy standpoint because it's a little bit of an extra burden from a commuting standpoint to get there. But at the same time, like you said, great buildings. I mean, incredible spaces, a lot of investment into amenities too.
Huge, gigantic.
So if you're willing to go there physically, then you've got potentially great buildings and great spaces for your people. But you're sacrificing maybe a little bit on sort of the, on the location, on the commuting. But it's those are the sort of options that I think users are going to start to look at with a closer eye.
It's just the tug of war between location. Companies were willing to pay more money to be in a more proximate location to transit, but now I think not that they are that much discounted. They are slightly, but not much. But what you get for your money at those locations are somewhat you can't replicate it. That the Terminal Warehouse and Starrett Lehigh has done an amazing job. So if you think about the type of companies that will end up going there and who their talent base really is, it's the creative types, it's engineering types, it's marketing, it's sales, it's product development, and where that talent really comes from. New York, Brooklyn, Hoboken, Queens. Exactly. It's not your typical, suburban Connecticut or Upper Westchester types. So I think getting that talent, once that talent is at that building, that environment will be second to none. And I think they're going to be very, very successful. Starrett Lehigh is already successful, but I think they'll be very successful just by what's transpiring in the market.
It's a great point, and I totally agree. I'm inherently biased as somebody who commutes in from more outlying suburban
Same.
New Jersey.
Same.
So that's
Same.
just the way it is. But I think you make a great point about the employee bases and the types of companies and the types of people that would be attracted to an area like that. And then on the other, it's a slightly different situation and I suppose value proposition. But going back to the financial district buildings, right? Buildings along Water Street, Wall Street, even Broadway, which some of those Broadway buildings have seen a lot more activity of late.
Definitely.
But some of them are solid Class A buildings.
Oh,
right?
definitely.
But the location, maybe not quite as desirable as something in core Midtown like Park Avenue. You're not going to get the brand new build quality of a Hudson Yards. But we were looking at the data recently and noticed that from a pricing and a concessions standpoint, when you compare Class B buildings in Midtown to Class A buildings downtown, outside of your World Trade Center buildings and your Brookfield Place, set those aside, the value is very, very similar. And what we're seeing lately, the past few quarters, is on average slightly lower rents, taking rents for the downtown Class A compared to Midtown Class B, and more value in the concession packages, and more availability. So just more options to potentially choose from.
Yes.
So, when you're comparing downtown Class A to Midtown Class B, I think that's speaks to where we're at in the market and is certainly very interesting.
Interesting. Well, Matt, I know we just started the fourth quarter. There's a lot of things happening. We know that you're closing, about to close, that will close before year end. I bring the crystal ball here before every session, and would love to get some of your last second takeaways here, predictions.
Of course. Yeah, we got our beautiful crystal ball. It's a little bit of a layup prediction, I must admit, but when I was talking about the leasing volume for the third quarter, right, 10.6 million square feet, that brings us to, I believe, 31.7 million square feet year to date. The 2019 annual total we tracked was 41.5 million square feet. So as of the end of Q3, we're just 9.8 million square feet short of that, with a reasonably strong Q4, which I expect based on the level of activity that's out there in the market. I think it's very likely at this point that we surpass 2019's leasing volume on an annual basis, which is just a huge sort of psychological hurdle for the market to clear. The last full year before the onset of COVID and everything fell apart, to surpass that level of activity would be very striking.
Yes.
I think we'll get there.
I think we'll get there too. That's terrific. That's great insight, as always. Really appreciate it. Well, look forward to seeing you in another 3.5 months.
Likewise,
right here.
Likewise.
We'll see how the year shaped up and see if those predictions came to light. But just want to thank you again.
Thank you, Jim. Appreciate it.
It's always a pleasure. Thank you, everyone, for joining us for this episode of the Midtown View. Again, I'm your host, Jim Wenk, and look forward to seeing you next time. Thanks.